Welcome to Understanding Life Insurance. Once again, my name is Joshua Feller, and I'm the founder of Feller Financial Services. At Feller Financial Services, we work with households from all different walks of life with the mission to get it right. Now, that's an acronym that we use to describe our core practice, which includes retirement planning, income planning, tax planning, and estate planning. Now, a properly placed life insurance policy is just one of many vehicles that we use to help ensure those core practice beliefs. So let's start with preferencing the question, why do you need life insurance? Before we dive into this specifically, I have a question. What do you think the most valuable asset is for a vast majority of Americans? And now I'm going to pause for a second to let everybody think. The most valuable asset for most people is actually their ability to earn income. Now, what would happen to your family if they lose you and your income at the same time? In addition to the understandable devastation of losing a loved one, they would have to deal with losing a significant amount of money. Now, even if you are a lower income earner, your family would need to replace that income to continue their lifestyle. And life insurance is the vehicle by which you provide for your family in the event of death. So what is actually the value of your income? It's probably actually more than you think. And this chart shows the total value of your income between now and the age of retirement or the age of 65. So think about what would it be to lose somebody, say a 35-year-old individual earning $100,000 a year. What they would earn is roughly $3 million by the time they would reach the age of 65. So the question is, how much do we actually need? That does depend on how much money you want to leave behind. On the screen, you can see some of the most common expenses for loved ones that will encounter from a death. You want to take these expenses into consideration when buying a life insurance policy. The first are just final expenses. Traditional funerals can cost up to roughly $10,000 to $15,000. The next is your mortgage or your rent. Your survivors are going to need a place to live. So if they lose your income, how long will they be able to keep up with the mortgage or the rent payments? And they probably want to stay in the residence in order to remain close to work and keep the kids in their current school. Now, the question is, will they be able to do that? Next is debt. If you're currently paying off student loans, credit cards, vehicles, and other debt, those loans will still be there if you pass. Your loved ones will need a way to keep paying those debts. Next is childcare. If you're the main caretaker for your child, your family will need to pay someone to provide for childcare. A USDA study found a middle-income family spends roughly $230,000 a year raising a child until the age of 18. And that's before the cost of college. College education. If your child will be attending, you might want to leave money to pay for that legacy. And there may be other reasons behind leaving a legacy. And the bottom line is finding the right amount of insurance that you will need will be different for everyone. And a financial planner can help you determine the amount that's right for you. So after you determine the proper amount of insurance that's needed, the next question is, what type of insurance are you going to get? Now, there's two main types of life insurance. There's term life and there's cash value. And we're going to dive into both of these insurances and the uses of each. First up is term insurance. Term insurance provides temporary protection for the term of the policy. If the insured dies within the term period, the insurance company pays out the death benefit. If the insured survives the term period, the coverage then terminates. Now, if you have an insurance policy through your employer, most likely it's a term policy that extends through the term of your employment. A primary benefit of term insurance is the low initial premium. These policies are well suited for shorter term, temporary needs, and most plans can be renewed or potentially converted in future years for a cost. Now, of course, there are disadvantages as well. If you outlive the term of the policy, there will no longer be a benefit payout, and the term insurance does not build any cash value. A variation of term insurance is called level term insurance. Now, level term insurance guarantees the same death benefit throughout the term of the policy, and the premiums are also guaranteed to remain the same. If the insurance protection is still needed at the end of the term period, level term policies generally will allow for coverage at an increased premium, but without evidence of insurability. The other type of insurance is cash value insurance, which builds value over time. This cash value is a living benefit for the policyholder. Cash value insurance is typically more expensive than term life insurance for reasons that we're going to talk about in just a moment. And there are two variations of cash value insurance. There's whole life, and then there's universal life. Either type of cash value insurance does have financial advantages. One is estate tax planning. Through the use of the unlimited marital deduction, a married couple can generally arrange for their estate in such a way that there is no federal estate tax that's payable at the death of the first spouse. Now, this does not mean that the deferral of the estate tax is eliminated. Instead, potential estate tax liability is postponed until the death of the second spouse, when the heirs may be hit with the federal estate tax bill. Cash value life insurance also provides benefits for those with special needs children. The policy can use funds to provide for a child's care and financial security at the death of both parents. And some of the cash value insurance can be used for substantial charitable gifts after the second spouse passes away, without depleting the estate that they plan on leaving to their heirs. Now, with whole life insurance, you get a guaranteed level premium and a guaranteed level death benefit as long as the policy is in force. Some policyholders will use the fixed premium as deposits into a savings account, which would be the future cash value of the policy. Whole life insurance has guaranteed cash value. The premium for a cash value policy is not flexible, though. And although future dividends can be paid to be used for premium payments, the cons of a whole life policy are that the death benefits may not keep pace with inflation, and the guaranteed cash value growth could be less than could be achieved through utilizing other types of investments. Now, universal life is another permanent type of life insurance. And unlike whole life insurance, the premiums are flexible, so is the death benefit. You can use the policy to build up value for your policy to reduce premium payments, increase the death benefit, and the cash value of growth in the universal policy reflects current interest rates with a minimum amount guaranteed. Disadvantages of a universal life policy include the possibility that required premiums may increase the older you get. And if interest rates grow slowly, so will your cash value. And only cash value life insurance has benefits while the insured is still alive. The policy can pay out in cash value, policy dividends, and loans and withdrawals. The cash value accumulations grow on a tax-free basis until the policy is surrendered, And if the policy is surrendered and the proceeds exceed total premium paid, the difference is taxable in the year received. And if the policy pays dividends, the dividends are actually considered a return of premium and are not taxable until the total dividends exceed the policyholder's basis in the contract, at which the time the excessive dividends are taxable income. Next, on to policy loans, which are not actually considered a distribution and as a result are not taxable. If, however, there is an outstanding loan when the policy lapses or is surrendered, the amount of the loan could be taxable. And cash withdrawals are tax-free until the policy owner has recovered his or her investment in the contract, after which excessive withdrawals are taxable income. Now, keep in mind, loans and withdrawals will reduce the policy's death benefit and cash value available for use in the future. The value of flexibility of life insurance frequently can be enhanced by the addition of other benefits, such as a waiver of premium, which is referred to as a self-completing feature. The waiver of premium allows premiums on a life insurance policy to be waived if the insured becomes disabled, as defined in the policy, and is available for an additional small premium. Next are the accelerated death benefits. Many insurance companies make it possible for a policyholder to collect all or a portion of the policy benefit early if the policyholder becomes terminally ill, stricken with a specified catastrophic illness, or requires long-term care. And lastly is the accidental death benefit. For a small additional premium, the insurance company will pay an additional death benefit in the event of an insured's accidental death. These are all add-ons to the policy, which can be included for an additional cost. So now that you know everything that there is to know about the basics of life insurance, what comes next? Well, the first step is to determine if you need life insurance. Now, as you might expect, and I think you do, life insurance is how you take care of loved ones in the event of your death. So no matter your income or your family situation, someone depends on you. Losing you and losing your income would be doubtedly devastating to them, and you don't want that for them. Next, we determine how much insurance you need. We might want to consider your income, as well as what do you want to provide after you're gone. From there, we look at term insurance and cash value insurance, as they both have valuable applications. So once you determine how much you need, you can decide the right type of insurance for you. And keep in mind that you might choose a combination of both to balance out higher coverage and more affordable premium. And this list might seem overwhelming, and the good news is you don't have to do it alone. We can help review your life insurance and find a policy that suits you. We have technology that can utilize to show you the proper amount of life insurance based on your personalized financial situation and clearly show the impact of how it would affect your family if, God forbid, you were to pass early, and show the uses for estate planning and legacy planning, all completing our goal of getting it right. And that's RITE, retirement planning, income planning, tax planning, and estate planning. Thank you so much for attending today. I hope everyone has learned some valuable information, and I'd like to end with a quote before I get back on camera to answer any questions. There are two types of pains in the world. There's the pain of discipline, and then there's the pain of regret. Everyone on this call is exemplifying the pain of discipline just being here today. But let's take it a step further and confirm you have the right and appropriate coverage for your family, because the pain of regret is not having the right coverage, and that would certainly hurt worse.